Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did.
Hi, everyone. Welcome to today's LinkedIn live event. This is our fifth one. And whether you're tuning in live or catching the replay, thanks for being here. My name is Marwaan, partner of Fortuna Advisors, joined by our CEO, Greg Milano. And as a quick introduction, Fortuna helps companies rethink how to allocate resources and drive long-term value. And over the years, we've worked closely with CEOs and CFOs on aligning performance metrics, capital decisions, and incentive design, really to foster an ownership mindset and culture within an organization with the ultimate objective of driving sustainable shareholder returns, which is what our conversation is today. And then over the next 45 minutes, we're going to walk you through what the right measure of performance is, the foundation of value creation framework that we recommend, and some of the key traits of an ownership mindset, what that means to create an ownership culture, and then an example of how an ownership mindset and culture really drives better shareholder returns. And so we expect to be about 45 minutes, but we hope to give you back some time, and certainly feel free to drop any of your thoughts in the chat, and any questions. We'll either answer them as we go along, weave them in, or answer them at the end of the discussion. On that note, let's get started. Foundationally, we start with an objective of increasing total shareholder returns and trying to achieve a top quartile performance in that area. The foundation of which is driven by a measure we call residual cash earnings. It's a customized cash flow based measure of economic profit. And that has a real strong relationship to changes in the share price, which then gives management the confidence that when they improve on this measure, they'll ultimately increase the company's value and share price. And this is really it drives three major benefits. The first is this measure provides better insights. You're able to discover the truth of where value is being created or destroyed. And with those insights, you can then develop strategies and make decisions both at a strategic level and a tactical level that will balance the trade-offs between growth, returns, margins, all these other metrics that you might use to ultimately create value. And then once you tie that to the incentives of an organization, it reinforces and creates even better behaviors. That all results in making what's good for the company and investors also good for employees and their families. And so this is foundationally what we start with when we're looking to create value for a company. As an example of sort of how this plays out, we actually did some analysis that we published in the Journal of Applied Corporate Finance. And what we saw was that companies that adopted this concept of economic profit, however you might measure it, we found that companies that adopted it created 4.7% more returns than companies than their peer companies, and 7% return additional total shareholder returns than those than the S&P 500 companies. And so you can see that when you adopt something like this, it in essence not only drives total shareholder returns, but fundamentally creates a mindset and an ownership culture that foundationally makes people make the right decisions. And so the question is what are those decisions? How does it do that? And Greg will take you through that.
So when we start off explaining this, the principles of thinking and acting like an owner at a company, whether we're speaking to a financial audience or a non-financial audience, we often start out by asking, what would you do if you owned the company? And by that, we don't mean, you own it for a couple of years, then you're going to try and flip the company. But imagine you're owning it for the long term. And, the people maybe gathered in the room when we're conducting a training session, imagine we all own the company and we're planning to own it long enough to pass it to our heirs. Now, if that were the setting, how would we think about planning and decision making and investing in the business and so forth? And if we think about what we would do if we owned the company, that's pretty much what we should do anyway, regardless of whether it's a public company or a private company where we might own none of the company or a very small part of the company. The behavior should be exactly the same. The behavior that would make the company more valuable to us as private owners is the same behavior that would drive the share price to be a superior total shareholder return, over the longer term. So whatever you would do if you own the company is the same as what you should do now. That's the main principle we want to get across. And act like you own the place is a phrase we commonly use. In fact, it's the working title of our next book that's being drafted right now. But we're going to talk today about what it means to act like you own the place. What are the behaviors we're looking for? What are some of the sort of cultural aspects and so forth? And to get us started, Marwan's going to walk through an example.
We'd like to use this example. It's a simple example. We use it whether we're talking to people with a financial background or non-financial background. I think it's important to see it in this context for people with a financial background because a lot of times we get pushback that this might be too complicated, and it really isn't. Most people without a financial background totally understand this concept, and they do because it's just common sense. It's one of these sort of truisms of finance or business or a first principle. It's a self-evident premise. And we always use this example where let's assume that you purchase some stock in a publicly traded laundromat business. And the reason why is because you have an affinity for clean clothes and you've always wanted to have your own laundromat business, but didn't have enough money maybe to kick it off. So you instead invested in this publicly traded laundromat business that had, over the last, let's say, 10 years, has generated a 10% return. Sometimes it's higher, sometimes it's lower, but on average, 10%. Turns out that sadly, there was a death in the family. And, but, thankfully it was a more distant relative. But in any case, they left you with some inheritance. And the amount that they left you was $10,000. That $10,000 was now something that was going to give you that opportunity to create that laundromat business you've always wanted to own yourself. Or you have the option of just investing in the publicly traded laundromat business that would give you a 10% return. So you decide, well, if I'm going to do this, what kind of profit would I have to generate to make this worthwhile? And so if you take the 10%, multiply it by the $10,000, it would suggest that you have to generate $1,000 of profit to make it worth your while. If you make the same, then you're sort of indifferent. If you make more, you're ecstatic. If you make less, you should have really put the money in the publicly traded laundromat business that was going to give you 10% return. So that 10% return, what that really represents is your required return. In the areas of corporate finance, they call that the weighted average cost of capital. In simplistic terms, it's just what's required to make it worth your while to invest in whatever endeavor you're looking to achieve. And then when you invest that $10,000, you're really putting it into what we call gross operating assets. It's the assets that are going to generate that profit. So it's going to be your washer, your dryer, maybe a truck, detergent, all these different things that you need to run this business. And then when you do, now you're looking at, well, what's the opportunity cost? This last $1,000, this $1,000 really represents the profit you need to generate. We refer to it as the capital charge. And so if we go forward and say, well, how did we do? Let's see actually whether we actually created value or destroyed value. Well, you can see here, if we calculate profit, and the term that we use is gross cash earnings. It's basically your revenue, less expenses. That's often referred to as earnings before interest, tax, depreciation, and amortization, or EBITDA for short. And then sometimes what we'll do is we'll add what we call P&L investments. It's expenses that really should not be expense because they have a longer life than the year in which they're incurred. And so we see more of a capital investment, something that we put on the balance sheet or treat as a gross operating asset. And so we add back those expenses to get a better calculation of profit. And then we subtract out taxes because there's two certainties in life, death and taxes, and that gives us our gross cash earnings, or GCE. So in this particular case, we generated $1,275 worth of profit. We have assets that we've invested, the washer, the dryer, that's our operating asset. is around 11,000, less any operating liabilities, non-interest bearing sort of funding that we're getting from some of our suppliers that we don't have to pay up right away. So that would be like accounts payable, any accrued expenses. We subtract that from the operating assets, and what we get is gross operating assets of $10,000 multiplied by the required return, which we showed before, and that gives us our capital charge of $1,000. So we needed to generate $1,000. We actually generated $1,275. So that the value that we've created is $275 that we could have otherwise gotten had we put in the publicly traded laundromat business. And this, believe it or not, this measure has tremendous impact in terms of this, the way people make decisions and how they think. And it really drives this ownership mindset. The key here is to always improve on this measure. And the reason why it's so much better than measures like return on invested capital or percentage measures like margins, which really talk to quality, not really quantity, or just, free cash flow, which is not a really good period measure of performance. It's very important when you look at net present value, and you'll get the same answer if you were to use our residual cash earnings. But what this measure does is actually takes into account both the quality of your investments and the scale or quantity. And then that leads to great behaviors and really embodies the 5 traits of an ownership culture.
Thanks, Marwaan. That's a great segue into the 5 traits of an ownership culture. So let me talk about them quickly to just tell you what they are, and then I'll go slowly through each one to be a little bit more specific about the sort of behaviors that we want and so forth. So the first one is spend money like it's your own. The second one is extreme prioritization. The third one is a willingness to fail. The fourth one is more doing and less talking. And finally, we have it's about both the long and the short term. We want incentives that encourage people to embrace these aspects of a culture and act this way when they're managing their particular role in the business. And from what we've seen, when people behave like long-term committed owners, they tend to deliver better performance. They tend to invest more in the future. They intend to invest more smartly in the future, I should say. And as Marwaan showed earlier, the company's embracing this kind of framework on average beat the market by about 7% a year. So it works really well. So let me take a step back now and go through each one of these in a little bit more detail. The first one is spend like the money is your own. And the easy sort of example we often talk about is consider someone flying business class to Europe on company travel, and then a few months later they fly economy with their spouse when going to Europe on vacation. And this is not treating the company's money like your own. You're spending a lot more of company's money to get to Europe than you're spending of your own money to get to Europe. And so you're not really behaving, like an owner in that instance. And there are a lot of other examples like that. But this is not just about managing cost. It's about optimizing value creation over time. So we not only want more incentive to stop bad spending, but we also want more incentive to initiate good spending. In a lot of companies, people don't invest enough in the future. Entrepreneurial owners tend to be much more willing to make big bets on and investments in the future. So we need both. We need the discipline, but we also need the willingness to invest going forward. So in order to explain this and from maybe a little different angle, we decided to give you some principles for context. And, these are sort of truisms and they've been written about by different people over the years, but this is our take on, sort of other people's money versus your own money. First is when you're spending other people's money on yourself, you tend to focus on getting as much benefit as possible with much less attention, to the cost. That's the business class airfare we just talked about. Second is when you're spending your own money on other people, you become very concerned about the cost and much less worried about the benefits. And the third example is when you're spending other people's money on different other people, usually you don't care much about the costs, or the value. You're looking for other objectives usually when you're thinking about this. And the best example of this that everybody's fully aware of are politicians, right? They're spending other people's money often for the good of other people. And their objectives very often have nothing to do with either of those parties. They have mostly to do with things like getting reelected and so forth. So, and we see the same kind of behaviors in corporate bureaucrats at times, maybe not quite as bad, but often the same kinds of behaviors where, people are spending other people's money in ways that benefit, other different other people. They really don't have a really good emphasis on either the cost or the benefits. And that's often a lot of why performance, really goes awry. Ideally, what we want is, the best behavior comes when people spend their own money on themselves. And so we want to create an environment inside the company that encourages people to think and act like the money is their own. And in the prior episodes of this LinkedIn Live series that Marwaan and I have created, we talked about how to measure performance. Marwaan talked about RCE a moment ago, but we also talked about how to use it in decision making and in planning and resource allocation. And very importantly, in the episode we most recently did, how to tie value to incentives so that we really are getting people to think and act like the money is theirs, because really a portion of it really is. The next trait is extreme prioritization. And I just flat out say it. Most companies have far too many initiatives, projects, investments, too many activities going on. And this distracts management and limits the success at the most valuable activities. And the Pareto principle, which many of you are familiar with, the 80-20 rule it's sometimes called, is really at hand here. We often find, if you look at 10 different activities inside a company, like these 10 columns you see in the chart on the right, 80% of the benefit comes from 20% of the activities, or in this case, 2 activities. All those other activities distract management's attention and reduce the chances that you're going to get the 10 and the 6 opportunity realized in the first 2 initiatives. And so, what we want is we want to prioritize the top initiatives, the ones that create the most value. And we always want to look at value, not accounting metrics, but value. And then we want to delegate or cancel all the other ones so that senior management is not distracted and they're focused on things that really genuinely move the needle in terms of value. The next trait is willingness to fail. And since we measure people against their budget or their plan, they often hesitate to put anything in the plan that they're not pretty sure is going to succeed. And when you only put initiatives in your plan that you're pretty sure are going to succeed, that really stifles innovation, right? Because innovation tends to come from trying things that you're not really sure if they're going to work. So, it stifles innovation. And it's important to note that most innovation comes from experimentation, trying things you're not sure are going to work. And when you have less experimentation because people are worried about hitting their plan, that leads to less innovation. And competitive advantages such as technologies, brands, and so forth tend to weaken because we're not spending enough to invest in them. In the short term, there often aren't really bad implications of this. And in this sort of quarterly earnings cycle that people emphasize so strongly inside far too many companies, the fact that the competitive advantages are weakening doesn't really move the needle in the short term. It only moves the needle in the long term. And usually by the time the brands are weak or the technologies are outdated or what have you, by the time that happens, it's often very hard and much more expensive to try to get back to where you were before. Making sure that you're experimenting and trying new things to be innovative, to reinforce the differentiation of your competitive advantages, is really very important. Now, it's also important to note that long before the financial performance starts to drop as brands weaken and so forth, valuation multiples often decline. The market's looking forward, and if a company is losing its competitive edge, their financials might not have dropped too much, but they're losing their competitive edge. The valuation multiples tend to go down because the investors see a less optimistic future, and it's that optimistic future that got you the multiple to begin with. So when companies say, well, our multiples were lower than everybody else in our industry, we're being treated unfairly by the investors and so forth, very often they're causing the very problem themselves by underinvesting in the competitive advantages that buttressed the valuation multiple to begin with. So we must encourage a willingness to experiment and sometimes fail. Now, more doing and less talking is really about analysis paralysis. And we've had quite a few clients over the years. I've been doing this work for over 30 years now. And in the 90s and every decade since then, I've run into companies that suffer from analysis paralysis. And to be fair, every company suffers from it at least a little bit, but some companies are really extreme. They analyze the decision. They have a meeting to discuss the results of that analysis. They decide they don't have sufficient information to make a decision. They identify what new information they need. They task people to go analyze it. And then after that's done, they meet again. And this is this cycle of never really making a decision and pulling the trigger. A few years back, I had the opportunity to speak to an executive who had been head of strategy at a public company, and then he moved to be head of strategy at a pretty large private company. And I said, so what's different? And he said, well, it's night and day. And I said, well, what do you mean? And he said, let me give you an example. We made a bolt-on acquisition recently. We had a handful of meetings. We figured we had all the information we needed to make the decision, and we decided, whether or not to proceed, pretty quickly. He said that exact same type of a bolt-on acquisition at his prior company would have had 10, 20, 30 meetings of every time people come up with new things they got to look at. They're afraid to pull the trigger. They're afraid to make a decision. And as I wrote in my book a few years back, if you make an investment that has $1 million of net present value, but you spend $2 million making the decision, that's probably not a really good situation. So we want more doing, more action, and less talking. And when you actually get down to it, behaviorally, people often have a fear of being wrong. And often that's because they're more exposed to bad outcomes than they are to good outcomes. If a project succeeds, there's limited upside reward. If it fails, they might lose their job or jeopardize a promotion. And so the downside is often much more severe than the upside. So we need to make sure there's a big upside for people when they do good things. There's a real, great value creation opportunity for them personally. And when we do that, we make it a little more symmetrical up and downside. We get people to sort of shake this off and make decisions, more quickly. So we need more decisiveness. So the last one is it's about the long and the short term, and just sort of briefly said, owners drive current performance as hard as anyone I've ever met. Some of the entrepreneurs I've worked with drive performance so much harder than I see in like public companies, but they never get there by sacrificing the future. They would never cut an R&D budget to hit an EPS number. They would never cut an advertising budget to meet an EPS number. They would never cut, if they're in the service business, they would never cut employee training in order to be able to achieve a short-term EPS goal. They want to drive current performance, and at the same time, they want to be making big investments in the future. And when you do both of those things, you tend to get good results now and good results later, and that's really what we want. So Marwaan's going to walk us through a case study now.
Yeah, this case study is really a good representation of what there looks like. What happens when you do adopt an ownership mindset and culture? The company here that we're talking about is Varian Medical Systems. It's a world-leading medical products company for oncology. And at the time when we started to work with them, they were experiencing stagnant revenue growth and total shareholder return right up until 2017, largely because they were so fixated on EPS, I would say, and return on invested capital, and percentage measures that really spoke to quality, but not necessarily scale. And that really impacted sort of the behavior of how they were allocating resources and how they were trying to create value for the business. And so during the time that we worked with them, their capital allocation was primarily focused on buybacks, as you could see from 2014 to 2017, the top pie chart there. And over the course of adopting this concept of this cash-based measure of economic profit, residual cash earnings, they referred to it as Varian value added at the time. So, because they just wanted to be part of their nomenclature within the organization. But during the 27-month period, the company started to reinvest their money into R&D, cash acquisitions. They did, I'd say, more with less CapEx, so they were even more efficient in that respects. Brought back their buybacks, and when in the 27-month period, not only were they creating value, they increased treatment of cancer patients from 2.8 million to over 4 million worldwide, having dramatic impact, I think societal impact, obviously in the lives of people that they were saving. And that all generated a tremendous amount of value. In fact, they grew revenue almost 4x from what they were before. Their share price improved 60%. And then they additionally got a 25% premium when Siemens Healthineers purchased them out in 2020. So effectively, they doubled their share price in less than 3 years. And that happens when you start treating the money as if it was your own. As Greg had mentioned, it's when you spend money like your own, it's not always being frugal and trying to reduce costs. It's also about investing in things that grow, investing in things that are going to create long-term value, like R&D, like cash acquisitions, maybe even CapEx when it's necessary. But they did a really good job adopting this concept. And you'll see what they came from in the next slide is they came from a position where they had all these different metrics, all doing different things, whether it was goal setting, budgeting, investor relations, communications, business performance. You had different functions using different measures for different reasons. But once you adopt one measure, which is RCE improvement, what you end up getting is a singular measure, one that provides focus, one that provides better insights, a common language, which then leads to better decisions, strategic planning, being able to rank investments and decisions to ensure the winners have the capacity to grow and the struggling units have to earn the right to grow. And then ultimately better decision making. What's good for the company and investors, also good for employees and their families. You create these organizational capabilities that then become a part not only of the incentive plans, but training programs, processes, communication, leadership development, the management tools, all can start to adopt this common language that really embodies an ownership mindset.
A couple of comments on this Varian case study that are additional points I wanted to share. When Marwaan and I trained people and went around the company running training sessions, one of our training sessions included quite a few people from research and development. And earlier, Marwaan talked about, being able to train non-financial people. And, that was a really good example of, a pretty non-financial audience. And by the end of the training session, it was an all-day training session with all sorts of case examples so they could get a really good handle on how to use the framework. By the end of the day, it was unbelievable the amount of support we had among them for just how intuitive it was, how easy it was to apply the math and so forth. Finance people often think this is more complicated than it is because it's different from accounting. But the non-financial people never really understood accounting anyway. And this is simpler for people to understand. And when we do case-based training, they tend to walk away with a pretty good understanding of how to use this and how to use it to make decisions. One more example I'd like to give from Varian, and this is talked about in one of my early podcasts with Gary Bishoping, who was the CFO when we were first hired by Varian Medical Systems. And it's about acquisitions. Two interesting things. Marwaan had shown on the prior page that the cash acquisition, spending on cash acquisitions increased as a percentage of total capital deployment. They made several bolt-on acquisitions, mostly software and training and services around their radiation therapy equipment that they were selling. So a lot of capital light activities to tag on to their very capital intensive main business, which was kind of interesting. And so they increased their investment in acquisitions, but at the same time, they had one case which has been written up in articles we've co-authored with both of the two CFOs that were there while we were working with them. There was another acquisition case where they were in contract for an acquisition for over $1 billion, and then someone else came along and made a higher bid. And they did the math using RCE and decided if they try to match that higher price, they're just not going to create any value. It was still a great acquisition. It made strategic sense, but not at that price. And they were quick to walk away. And a lot of companies, what we see is, when a competing bid comes in, they quickly change their forecast to justify a higher MPV, and they go and they make a counter bid. In this case, they didn't do that. So they had more of a willingness to invest in good things, but more discipline about making sure they were doing so, at a good price. And a lot of our research, by the way, shows that most acquisitions create value. It's just that people pay such a high price that more than 100% of the benefits are often given to the selling shareholders, and not much is left for your own shareholders. So that discipline around not paying too much for acquisitions, while being very eager to do them in general, was really very owner-like. It was a really great, sort of behavior. Marwaan, do you want to cover this page, and then we can see if we can cover a few questions before we wrap up?
Yeah, I will add, though, with the Varian case that you mentioned, not only were they disciplined, but they were paced in that decision. In that, I think they basically whiteboarded that in about 15 minutes, mm-hmm. And it speaks to what you were saying. It's when you're not focused so much on accounting, but just thinking about the economics of business. It's a lot more intuitive to the people in operations, whether it's in the sales. Like I find sales loves this stuff. I find the R&D, like at Varian, love this stuff. Operations loved it because they were less focused on the accounting, more on the economics of the business. And I think it resonates. A lot of that discussion, by the way, can be found in one of the latest issues of the Journal of Applied Corporate Finance. It means a lot to us, actually, because we were honored, as a thought leader for the Journal of Applied Corporate Finance by having the whole publication dedicated to the articles we've written over the years. And as a complimentary thank you for those who have watched this either live or maybe on replay, you can email us at info@fortuna-advisors.com. And in the subject line, put in JACF request live LinkedIn, and we'll send you a complimentary copy if this is something that you might be interested in. On that note, should we answer some questions that we typically face? Yeah.
So how long does it take to adopt this framework? Do you want to comment on that, Marwaan?
Sure. It again, it all depends on how far you want to take it and to what degree you want to take it. If it's just simply like, using the metric and just calculating it, it doesn't take much, right? But if you truly want to adopt it, create an ownership mindset. Number one, it's like anything worth doing. It's a continuous improvement process. But the initial engagement, would probably take anywhere between 8 to 12 months. 8 to 12 months gets you an understanding of the measure, actual proof of concept of how it applies to your industry, your company. It allows you to take a look at and create the case for change. So there's really 4 questions you want to answer when you're taking a look at this. One is, what's the reason, a need for change? If so, what does the future look like if you do make the change? Then answer the question of what's your part, or what's an individual's part in creating the value and being a part of that change. And then it's what's in it for me, which is, how do you get rewarded for actually adopting this? And initially you'd be looking at 8 to 12 months to really get things adopted, socialized. But then afterwards, you want to create the organizational capabilities where it becomes part of the organization. So that then runs, beyond the 12-month period initial process. And then that's what I found. I don't know, Greg, do you have any other views on that?
Yeah, I just would say it varies a little bit based on the complexity of the company. If you have a pretty straightforward company, maybe a few different business units, but generally in the same type of business, and not too large and complicated, I think what you just described, applies. We've worked with some companies that are much larger with many different businesses, sort of a conglomerate type of business where, each one needs maybe certain types of special treatment to get the measure right and different types of drivers of their success. And so I think it can take longer in a more complex company. But I think it's also important to note, and this is something that's, it's still in development right now, but, over the years, this kind of a framework has generally been available, to companies that are at least, upper medium, if not large companies, because of the cost of bespoke consulting services and so forth. And we're working on an approach to this that would be available to much smaller companies with much more like computer-based training and how-to guides and so forth. And all that we're developing is going to make our larger projects more efficient and effective as well. So, at some point, we're going to be looking for some companies to pilot that more scalable approach that's more suitable for smaller companies with us, to really develop it and make it available. But with the results showing that on average, companies that embrace this kind of a framework beat the market by 7% a year, we felt it was really important for us to try to make it available to as many companies as possible, regardless of how large or small they are. So, that's coming. That's in work. But anybody who wants to inquire about that, please reach out to us at that same info@fortuna-advisors.com email.
Yeah. I also note that it's not just publicly traded companies we work with, a lot of private companies as well. And actually, they really take a shining to this because a lot of these private companies have a sense of ownership, especially, at the higher levels of the organization, because it's usually run by an owner. But when they're looking at second and third generation and possibly even a professional management team to take over, this is what they love. They love this concept because it's basically passing the torch over to somebody to think like an owner. I got another question here. What are the key challenges you face when you have an organization adopt this?
Let me make my maybe first comment on that, and you can chime in with some additional thoughts. It depends a lot on the organization, right? I mean, some companies are so myopically focused on, quarterly EPS that the people in the company just view that as normal, and anything else that you do is viewed as, sort of crazy. The world doesn't work that way. And it's a real change management process to try to make the change. And, you have to actually, sort of sit in the meetings to hear the way the behavior is transpiring, to figure out how to coach people to do things differently. And I'll just give an example. We talked a lot in our prior episode about how we separate our incentive performance targets from plans and budgets. We don't use plans and budgets at all in setting performance targets, which frees the planning and budgeting process up to be much more about, sort of trying to create the best plan for the future as possible, and less about trying to get an easy benchmark. And in one company, I remember, we did that, and we educated people on the fact that you're no longer going to be measured against your plan, and yet the plans were still sandbagged, and we couldn't figure out why. And then I got to sit in on an operating review one quarter where each of the businesses got up and kind of explained what was going on. And everything about that operating review was variance to plan. And so even though we changed the incentives to try and change the behaviors didn't change because there was another process still reinforcing sandbagging your plan. If you're going to be beaten up when you don't hit your plan, even if the incentives aren't tied to it, you're still going to sandbag your plan in order to get something that's easy to beat. And, sometimes it takes a lot of work to try to find all the ways that your management process is encouraging these adverse behaviors, and in order to fix them and get the traits of an ownership culture that we talked about. And by the way, we created those traits. We identified and wrote the original sort of article describing those traits about 7 years ago because people kept asking us, what are the behaviors you really want? And so that's the sort of codified version of it. But you have to accept the fact that it's the management processes that are in place when this journey starts that are causing those behaviors. And so it's not just a matter of embracing something new. We have to figure out what's wrong with the existing processes and fix them so they support and align with what we're trying to do as well. And sometimes that can be a real complex obstacle to overcome. But that's key to getting the benefits that we that we want.
To add to that, I think is a really good point, is that out of all the organizations that, we've worked with or I've worked with, the one element that they love the most about the concept, just of thinking about residual cash earnings and using it, is when we tie that to incentive comp, largely because it's all based off of improvement, not based off of plan. And that is I would say the greatest feedback I've gotten is, we love it, Marwaan, because we don't have to negotiate plans anymore. We still make the plans, but the plans are there's something of value. There's something about stretching for greatness rather than sandbagging for negotiation. And so that's one of the things that gets me fired up about this is once we get people seeing how you can strive for greatness and get rewarded for it, not strive for greatness. It then gets put into your plan, which then makes your targets much tougher, right, to accomplish, and you never get the benefit of this greatness that you created. So I think that's a very good point. How about this one? If it's so effective, why don't more companies use it?
Let me give a short answer, and then maybe you can chime in. I mean, on the surface, I will say this has been one of the sort of frustrating things of my career. If you had asked me in the 90s when we were implementing EVA with Stern Stewart, I would have guessed that by now over half the companies in the world would be using a value-based framework to drive management. It's so proven. And the research we did back then showed the companies beat the market by 8% a year. The research now shows 7% a year. It's so straightforward and so proven. It doesn't make any sense that more companies don't embrace it. But it is hard, right? Culture change is hard. And, if you went and asked, a bunch of random investors, they probably don't know about this kind of a management framework. And what they do seems to align with it very well because we track share prices better than any other financial measure. But, if they say, oh, I'm not really familiar with that, that doesn't give you a lot of confidence that you should embrace it. We always say, go by what investors do, not what they say, as an important reason for embracing this kind of a framework. But over the years, we've developed some sort of small, we call them TSR diagnostics, so people can dip their toe in the water, see how this works for their company, see how well it correlates with their share price, see what it looks like when they benchmark against peers, understand some of the flaws with their planning and their decision-making and resource allocation processes and their incentives, and then, sort of frame out what it would take to embrace this, and only make a decision as to whether or not they want to embrace it after they know all that. Because, if you don't know all that, it's really easy to just say, no, we're good, let's not pursue that. But, for a very high percentage of the companies out there, their TSR would be better if they embraced this kind of a framework. So, getting past those obstacles is important. What do you think, Marwaan?
Well, it's funny because it's a bit of a paradox, right? The less that other companies adopt it, the more advantageous it is and more of a competitive advantage it is to adopt it, right? So it's like having more people adopt it is not so great if you're trying to get a competitive advantage, which is kind of funny, right? And you can see that in the exceptional returns of those that do actually adopt it. They get higher returns versus their peers, and broadly the S&P 500. One could, and then of course that could be a great argument of how that really demonstrates there is a competitive advantage, and competitive advantages are meant to be difficult to replicate. So I think, it's tough to do. A lot of people often think it's just adopting a new measure. And when in fact, it's really about adopting an ownership culture. And I also think that management often move up the corporate ladder and their responsibilities are typically on the P&L basis, right? Not balance sheet, not what's being invested, until they become a CEO or CFO. And then by that time, breaking old habits are pretty tough to do, where like most people stick with what they know, right? Let's increase revenue. Let's increase margins, maybe return on invested capital, but that even starts to dwindle because the balance sheet comes into play. And then they always get rewarded as they're climbing that ladder. They get rewarded with promotions for achieving success in those other metrics that don't necessarily embody old value creation.
Mm-hmm.
And so then, what do you do when you get to the CEO, CFO level? There's a real big temptation, not at their fault, but, to really do what you used to do before, right? Stick with what you know and worry about negotiating plans rather than really thinking about the value creation, because that's what you had to do you had to negotiate for bigger budgets rather than think about how you're going to allocate that budget. To drive adequate returns or returns that are going to create value for shareholders. So I think it's just this path dependency that happens over time. And then, as companies will adopt it. They'll be doing really well. A new CEO comes into place and, they'll want to go and, adopt something else because it's new. But we're making the good fight. And with the ones that we do get to work with, it's fun to watch.
Yeah, it's a real competitive advantage.
Yeah.
We're just about on time, so I think we'll break there. I hope those who've tuned in or who watched the replay enjoyed this. It's going to be also repurposed as an episode of the Create More Value podcast. And, reach out to us if you have any questions. Thank you.
Thanks.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.